and their algos that beat you to the entries and exits necessary to scalp profitably. And this is also not correct. In the type of scalping that we do, and which we'll be teaching you in this workshop, we are looking for very specific opportunities with very defined rules that allow us to get great entries and exits without fighting the algos. So it is more than possible to scalp profitably, even in a market with algos run by quant firms. And finally, some people say that only young and fast traders can scalp. And you might have gotten that idea yourself, since most of the traders you saw in the video happen to be young. But again, this is also not correct. While younger traders may certainly have some advantage, the type of scalping we're talking about is not a speed game, but rather just a pattern recognition game. It's about spotting the variables which we lay out specifically and then following the precise rules to capture the opportunity. This is how we train the new traders on our trading floor, and this is something any trader can learn to do no matter their age. And this is especially true with the revolutionary trading tool that we'll be revealing here today, which does 80% of the heavy lifting for you. So no matter what age you are, it's a game changer. Alright? Now, I do need to make a very important point here before we dive deep into things. And that's that we are not here to offer traders some automated trading system or alert service that spoon feeds you trades. Now, there are two major issues with such systems and alert services. The biggest problem with most trading signals is that they have no real-world edge. They're sold to independent traders based on extensive backtested results, but what most traders don't realize and understand is that these results are most often curve-fitted and over-optimized, which simply means that the signal developers use past market behavior to create the signal itself, which makes it highly unlikely that the signal will continue working into the future as market conditions change. Whereas true robust strategies aren't built off of specific backtesting periods, but are based on key principles that stand the test of time. And obviously, none of our trading strategies are created by simplistically backtesting back markets. They're all built from 2 decades of real-world experience of dozens of elite traders who experiment relentlessly and fine-tune endlessly until they have robust strategies that stand the test of time and varying market regimes. Alright? And the second major problem is that even if a trading signal service was robust and profitable in real-world markets, if its job was to fire off to signal real-time entries, which pretty much all the signal services and software sold to retail traders do, i.e. they spoon-feed them trades, it would be very difficult to actually catch the trades at good prices if it's an active system, which any scalping system is by default. Why? Because by the time you get the entry signal, price is usually moving rapidly, and you're not actually going to get filled at the prices that all the backtesting shows that, this thing has an edge. And even if you do catch some here and there, you've built up no real trading skill because you simply followed a purely automated signal that spoon feeds you trades. Where's the skill in that? If the signals stop working, which most do, your whole edge suddenly disappears and you're a no better trader after trading the system than you were before. But remember, we are a world-class proprietary trading firm whose main business it is to build elite traders with elite skills that stand the test of time. Which means that not only do our trading strategies have a robust edge that work in continually changing market environments and regimes, but any trading tools that we build are always primarily built to help in the process of efficient skill development. And that's precisely what the revolutionary scalp detection tool we're about to reveal here today does. Like I previously mentioned, we found scalping to be the easiest and fastest way to turn new and developing traders into consistently profitable pros. And that's what we've placed much of our attention on over the years. But recently, we started exploring how we can get our new traders out of the gates and into consistent profitability even faster. Remember, we spend a lot of time and money training our new hires, so the faster they become profitable, the faster we can grow our firm. And what we realize is that the place where the most potential for accelerating progress lies is in trading execution. Just like we're going to teach you 5 of our top scalping strategies right here in this workshop, we can pretty quickly teach our traders the rules and execution guidelines of each of our scalping strategies. Since we've systemized each strategy over many years of experience, they've become quite straightforward to teach. But here is the real issue. With a universe of over 4,000 stocks, how can you find the specific stocks setting up for these 5 scalping strategies in real time and with such speed and efficiency that you can catch the trades in time? Think about that. It's extremely difficult and it takes literally years of experience and time at the screens to know which stocks to be focused on that are likely to produce these setups on any given day, and then an incredibly trained eye for pattern recognition to quickly spot the scalps setting up in real time throughout the day without missing them, or worse yet, thinking that they're setting up and lunging into trades when they really aren't. Because it's not just about being able to recognize the setups quickly, but it's also about having the confidence that you're reading the charts correctly and that the scalp that you think is setting up is actually setting up. You see, traders can fool themselves and rationalize trades based on their current emotional state. If they're feeling extra confident after a string of winners, they can quote-unquote see certain trades setting up that aren't really actually textbook trades, but more like very loose interpretations. This can also happen if they just happen to miss one or more textbook trades and now they're revenge trading and assuming certain trades are setting up when they really aren't anymore based on the rules. And conversely, if they're feeling a lack of confidence after, say, a losing streak, they may question valid trades altogether and miss them, only to FOMO in after the trade is no longer valid. And I'm sure you've experienced what I'm talking about if you've been trading for even a short length of time. Now, on our desk, these problems are solved in a twofold manner. Number one, we've built a proprietary stock scanner that automatically finds all the stocks in play on the day based on the key variables that we'll be teaching you in this workshop. Alright, so on any given day, instead of having to focus on the entire universe of over 4,000 stocks, the focus is narrowed down to typically just anywhere between 20 to 80 stocks. But even then, actively stocking 20 to 80 fast-moving stocks during the day is insanely difficult, even for experienced traders. And spotting the trades quickly and properly without the psychological biases that I just mentioned getting in the way is even harder. That's why the second way we solve the execution issue on our desk is to have our traders mic'd up and connected to each other in team trading. This way, the super experienced traders call out the trades that they're seeing in real time, and one set of eyeballs gets transformed into many sets, effectively making it much easier to detect great trading opportunities in a timely manner across a large number of stocks throughout the day. And this helps the developing traders catch setups in real time and feel confident that they're entering valid trades that their mind is not fooling them about. Now, as a proprietary trading firm with over 50 professional traders, we have the ability to do this, and it has worked very well for us. But even then, our newest hires can still struggle to keep up with all the traders talking on the mic and know what to execute and the precise moment to do so. But over the past year, we have spent a ton of time creating a revolutionary solution to this execution problem. Our head of trader development, Jeff Holden, who will teach you all the strategies today, spent an entire year working with 2 of our in-house software developers to create a trading support tool like no other. We call it the S&B Scalp Radar. And it is currently revolutionizing the way we train our new traders to become consistently profitable through scalping. Now let me show it to you and explain what it can do. And to show it to you, I've captured a screenshot of it at the end of a recent typical market day. So the first thing you'll notice is the names of the 5 unique scalping strategies that we trade that you're learning here today. Now each day will be unique, and on certain days all the scalps will have a very similar number of trade alerts, whereas on other days 1 or 2 scalping strategies will be really in play, such as this day where the fashionably late strategy had a bunch of trade setups, and so did the rubber band. And the backside and the hitchhiker only had 1 each. Just depends on the day. It varies every single day. Now, where it gets really interesting is that the Scalp Radar has been meticulously programmed with an algorithm that detects each of these scalps in real time and fires off potential trade alerts the moment it happens. Okay, the alert literally just pops up on your screen in real time, so you know exactly what stock to pull up and which scalp is setting up. So for instance, here on this day you see that Google fired off a long around 2 p.m. Eastern, and it was a backside setup. Right? So the alert will come up, and then these will stay so you can see what actually set up during the day, and you can review them at the end of the day. Right? But here's the cool thing. These alerts are not firing off at the moment of the buy or sell signal. If that were the case, most often you'd have almost no time to actually execute properly, like I mentioned earlier. If you're not already a highly profitable pro, by the time you pulled up the chart, remembered the entry, stop, and exit rules of the setup, along with the other important execution guidelines that greatly improve the odds of success, you would have missed the trade 9 out of 10 times. So it wouldn't be that revolutionary for you as a developing trader in terms of it helping you accelerate your skill building and becoming consistently profitable. And that's precisely what makes the S&B Scalp Radar such a unique and revolutionary trading tool. When an alert fires off, it's not telling you to instantly rush to try to enter the market fast enough to cash the trades. Instead, it's programmed to alert you when a scalping setup is potentially about to fire off, because all of the key trade variables are setting up in the right way. So, based on our experience with the Scalp Radar, when you get the alert, you typically have about 2 to 10 minutes of time to get ready for the actual trade signal to fire off. So here at 2:03 p.m., it wasn't that a Google entry fired off, it was that an alert fired off telling you, hey, there could be an entry in Google. And it'll typically give you 2 to 10 minutes to check out the chart and see if the actual entry occurs based on the simple rules that you have directly in the cheat sheet. So you not only have the time to pull up a chart of the stock and study the price action, but you even have time to pull up the scalps trading cheat sheet to remind yourself of the exact entry, stop, and exit rules, and even the specific execution guidelines if you're still in the learning phase. So you could, for instance, notice that none of the factors that increase the odds of success are present, and in fact, one key factor that decreases the odds is there. You may also notice that it's not the ideal time of day for this setup, based again on the execution rules that are detailed in the cheat sheets. This combination of factors may make you choose to not take the trade if it fires off with an actual entry. And I say if it fires off because not every single potential trade alert becomes an actual trade that fires off. From our real-time testing over many trades, we found that typically around 50% of trade alerts actually become real trades that fire off. For the rest, the stock doesn't actually create the entry signal. Right? Again, this alert is just giving you a heads up that, hey, things are all shaping up to potentially be an entry for this scalping setup. But sometimes those variables kind of fall apart and that doesn't follow through into an actual entry. And this is actually great because it perfectly reflects real-world trading. In real-world trading, professional traders will often closely stalk a trade for minutes before pouncing the moment it actually gives them a reliable and robust entry signal. If it doesn't give that entry signal, they have the discipline to let it go, and this can indeed happen about 50% of the time, or even more. So you're getting trained for real-world skill building. And on a typical day, you'll have anywhere between 15 and 25 scalp alerts, which will result in around 7 to 12 actual trades, which is plenty to build skill on and make great potential profits from. In fact, the relative high frequency of daily trades is precisely what makes scalping the fastest way to consistent profitability in our experience. You simply have far more repetition than other styles of trading, and repetition is what builds skills. And so, because the SMB Scalp Radar is built in this way, it helps you build real-world skills by stalking trade alerts and then letting go of them if the entry signal doesn't actually trigger. Moreover, like I mentioned previously, you're using your understanding of the execution rules and probability factors of each setup to decide if it's setting up in the ideal way or not. And if it's not, you let it go. They're very simple rules that you can easily follow, even if you're a relatively new trader. And if it is setting up, you pounce and go for blood. But while you're doing this, you don't have to sit there and second guess whether or not your mind is fooling you about this being a legitimate trading setup with an edge, because the Scalp Radar is finding it for you. So by definition, if it's alerting you to it, you know this is a potentially valid trade setup with a robust edge. Its algorithm is built precisely to find these setups, so you don't have to do any of that work. You don't have to stare at the charts and wonder and guess and be fooled by your mind and be scared that this isn't a setup when it actually is, or this is one when it actually isn't. That's all done for you. So regardless of your current psychological state, you can have the confidence that the trade setting up has a robust long-term edge. And then your only job is to check the systematic rules to see if the odds are stacked in your favor, or if there are one or more variables mentioned in the rules that say not to take the trade. And I can't tell you the difference this can make to your mental state and in turn your consistency of execution. It is truly a game changer. Over time, this kind of confident execution builds up real trading skill and innate pattern recognition abilities, such as that after a few weeks, you'll know each of the scalping strategies so well that you won't even need the cheat sheets. Now that skill will be embedded in you, and the Scalp Radar will simply be a highly efficient machine that finds potential trades for you in real time and alerts you to them, so you don't have to do the nearly impossible job of trying to find them yourself in a sea of volatile stocks. And notice the difference between this and the automated systems and alert services that are sold out there by retail trading vendors. You learn no real-world skills with those. Execution often is very inefficient because the entry is being given in real time and you barely have time to catch it. And there is zero discretion, so you're just trading a black box system that you don't know how it really works, and if it stops working, you have no edge and you've developed zero skill as a trader. This is not what you want for your career as a trader. You don't want to be spoon-fed trades with actually a very low chance of making money over a long period of time. You want robust strategies that have stood the test of time, that you learn how to trade yourself, that you build up real-world skills on, and that you simply get a lot of help making the execution much more efficient and easy. That's the way to do it, and that's what this revolutionary tool does. Alright? And by the way, the Scalp Radar has the SMB stock scanner built right into it on the back end. So it's choosing potential scalps only out of the stocks that are in play for the day, because our proprietary stock scanner finds and displays those stocks every day. This is already by itself a huge source of edge, because being in the right stocks that move cleanly is half the battle in your attempt to scalp profitably. So when you get a potential trade alert, you not only know that it's a robust setup, but you also know that it's coming from a stock that's in play on the day, which greatly increases the odds. And add to that a tool that not only streamlines your trade execution by doing most of the heavy lifting, but which does it in a way that supports real-world skill building, and you have what we feel to be the most revolutionary trading support tool in existence. In fact, our new and developing traders are raving about it and how much it's accelerating their skill building process and their path to consistent profitability. And these are traders who already have access to proprietary software like the SMB Stock Scanner and who are connected to trading teams within SMB that are calling out trades and scalps all day long. So if even our new and developing traders who already have so much support are finding the SMB Scalp Radar to be so helpful and revolutionary, what could it mean to you as an independent retail trader without any of that support? We believe it's a true game changer. Not only is scalping, in our 2 decades of experience training traders, the easiest and fastest way to become profitable, but now we've built the tool that, to us, is clearly the easiest and fastest way to learn how to actually execute scalps profitably in real-world markets. And what makes this all even better is the ease of use. We wanted to make it super easy for our own traders to use, so there's literally nothing you have to install or do manually. You simply log into the custom-built Scalp Radar scheme that looks just like this, and it generates all the trade alerts for you in real time on an ongoing basis, and it even keeps a historical archive of all the setups of the day so you can go back and study any trades that you may have missed or further analyze the trades that worked compared to those that didn't, so you can potentially gain even more insights and improve your skills more rapidly. All right? And so, having said all that, let's make all this real for you by actually giving you the exact execution rules of each of these 5 scalping strategies and show you a bunch of real-world examples of how and why they work so well, so you can get an even better understanding of what this revolutionary tool can really do for you. And it's important to understand why we're teaching you 5 strategies instead of just 1 or 2. It's because if you want to be consistently profitable, you need to be able to trade the constantly changing market conditions. Sometimes markets are choppy and range-bound, quickly reversing both up and down moves. And for these types of markets, you need to trade mean reversion scalping strategies to be able to make money. At other times, markets in certain stocks suddenly transition by breaking out from ranges, and for these types of markets, you need breakout scalping strategies to be able to make money. And at yet other times, markets and certain stocks are in full trending mode, and you need momentum scalping strategies if you want to capture profits reliably. And so as you'll see, we have strategies for each of these market environments. We have 2 that are mean reversion strategies, 1 that is a breakout strategy, 1 that is a momentum strategy, and 1 that can be used for both momentum and breakout, effectively giving us 2 robust strategies for each type of market condition. And that is why our traders can be consistently profitable regardless of market conditions. They have the right tools for each type of market. And that is key for you if you want to become consistently profitable. Right? You cannot hope to achieve that by trading only one type of strategy which only works in a small subset of market conditions. And lucky for you, we're going to be teaching you all 5 in this workshop. And once again, for those who stay until the end, you will receive all 5 cheat sheets that detail all the exact rules as well as added execution instructions. So do not miss out on that. It is not every day that a world-class proprietary trading firm with 7 and even 8-figure per year traders gives away its exact trading secrets to independent traders. I mean this very sincerely when I say you are fortunate, so do not waste this opportunity. Stick around to the end of this workshop in a focused mode with as little distractions as possible. And with that said, let me bring on our head of trader development, Jeff Holden, to teach you each of our unique proprietary scalping strategies. You'll recognize Jeff from the video you saw earlier where you saw him training our traders in the SMB meeting room, which he does daily. So here is the training session that Jeff has prepared for you.
Thanks for the intro. Welcome everyone, and buckle up, because I'm about to teach you the exact same scalping strategies we've been using for years on our desk to pull consistent profits from the markets in all types of conditions. And let's get started with our first strategy, the fashionably late scalp. A few years ago, we were wrapping up a trading day when I bumped into one of our traders who was also waiting for the elevator. We started chatting about some of the recent trades we had made, and the conversation quickly turned to the specific things we were working on in our trading. As we walked on the busy Midtown Manhattan streets, this trader kind of mentioned that he was struggling with being early in trades he saw setting up, and that he just wasn't getting the consistency that he wanted in his trading results. He had been a successful trader at times, and other times he was inconsistent and would lose confidence in his trading decisions. It not only led him to cut a position at what felt like the low because he was nervous about the move continuing against him, but even if the trade did work, he found himself exiting the position too early, leaving a ton of profit on the table. I knew the haunting feeling this causes, and I distinctly remember the early trading pain of knowing that I saw the opportunity setting up, but feeling like everyone else was crushing it in a move that I saw. Like I knew what was going to happen, but I would exit early because I had spent so much mental capital fighting with the stock before the move really started. And then I was so nervous it wouldn't work and that it would go against me quickly. So right when I would feel the move start to move in my direction, I'd make a different mistake and I'd exit too early because I just wanted to be sure to make a profit on the trade after having sat through so much in it. As we walked past crowded bars and restaurants, past people having a great time, he kind of remarked that when it feels right, when he was trading that trade well, it felt like he was walking into a really fun party that was already rocking. You know, when you walk in and the music's pumping, the energy's already rolling, everyone's enjoying themselves, and it's easy to just come right in and have a great time. You almost know that you're going to have a good time as soon as you walk in the door, instead of that awkward feeling you get when you enter a dead party. As he said this, as he remarked this, suddenly a light bulb went on in his head, and I saw his entire energy level change. It hit him that he could build his trading edge around this insight. So we started chatting about some ways he could play the right game for him and take the pressure off himself. Specifically, ways he could be late to a move, entering when the party's already started in his direction, and still do really well, instead of having to sit in a trade wondering if it would start working and going into psychological turmoil, which then would destroy his trading results. He quickly went to work on this core idea, and he eventually created this trade, this scalp. He developed this unique strategy to really take advantage of being late to a trade and let the opportunity hit him between the eyes after all the momentum is back on his side. It helped him trade with much more consistency and much more size, and really changed him from being uncomfortable in his trades to being able to enjoy the whole process. After he started to show so much consistency with this strategy, we started remarking how good he was at being late to the party. He hated this term. And since he was doing so well with his trading, we started to say that he was so good at being fashionably late. And with that, the fashionably late scalp was born. Let's get into it. The first thing you need is a stock that is in play. What this means for SMB is a stock with a significant fresh news catalyst. A stock trading at or around a strong support or resistance level. A stock trading with elevated relative volume, or what we call RVOL. Generally 3+ RVOL is key, which means that the stock is trading on 3 times the amount of volume that it usually trades on. For a stock to be in play, you need at least 2 of these 3 factors, and ideally you'll get all 3. We focus on stocks that are in play because they will display great volatility and liquidity. Without volatility, there's kind of little opportunity. So we want stocks that have the potential to make big moves and to quickly move away from our entry, which is super important because when you're right, you can make a nice chunk relative to your risk and you don't have to wait forever for it to happen. And we need liquid stocks so we can get in and out of the stock without much slippage and put on big size. I can't really overemphasize how important it is to limit your trading to stocks that are in play. That alone can be a difference maker in your trading. Okay, so for this scalp, you have a stock in play, and it makes a sharp, sustained move in either direction. In this case, we're going to talk about a long, and then we'll cover shorts in our examples, but let's focus on the long here. So in this case, the stock makes a sharp, sustained move down. And the 9 EMA, which is that 9-period exponential moving average, and the VWAP, which is the volume weighted average price, those two indicators diverge. By diverge, we mean the distance between the two expands. Now, it's really critical we understand the importance of this divergence. These two indicators are actually very different indicators. The 9 EMA tracks price relative to price. It's a moving average of the price itself, whereas the VWAP tracks price relative to volume. It shows you what the average price is when you factor in the volume trading at each price. So as these diverge and get further apart, it's telling us that there is likely an unsustainable move occurring as price is potentially moving too far, too fast. And with that comes the potential of a nice reversal occurring. But remember, for this scalp, we don't want to try and catch the turn. Instead, we want to be fashionably late to the party that's already rocking. So for this scalp, once the stock is put in a low and VWAP and the 9 EMA start to converge, we can begin to focus in and observe if the momentum has been building for us, giving us a chance to get in for an easy money scalp from the way this divergence corrects. What we're actually looking for is the momentum shift in the direction of the 9 EMA after the low has been put in. This shows us the party got going in our direction, and we now have edge in this scalp, giving us a nice opportunity to ride along with the new trend and capture the real momentum of this move. This scalp happens in both directions, so we can easily flip the charts depending on the way the stock is set up. And after we cover the principles of this scalp, we'll go through long examples and short examples in detail. Now, please note that there are countless trading strategies out there that use moving average divergences, convergences, and crossovers. But invariably, these strategies involve 2 or more price-based moving averages. And there's really no unique edge around that. But what we're doing here is watching for divergence, convergence, and crossover of 2 very different moving averages, one price-based and one volume-weighted. And that makes this strategy very different and unique from virtually everything out there. When an upsloping 9 EMA gets ready to cross a flat or a downsloping VWAP, we can enter the trade in the direction of the slope of the 9 EMA. Okay, it's so much easier to see visually. So you notice how the 9 EMA, that's that blue line on the downside, and how it extends away or diverges from VWAP, that purple line. We don't need an exact rule on how much this divergence must be, but a general guideline is we look for the divergence to be about 1/3 of the day's current trading range. We really zone in when price, the bars, have recovered the 9 EMA, and then we get hyper-focused when we see that 9 EMA begin to upslope while the VWAP is still relatively flat. At the moment that we get the 9 EMA crossing back above VWAP, we can enter a position looking for the momentum to continue to the upside. Because of the edge that divergence, the convergence, and the cross gives us, this is a trade where we can enter with the trend. We enter aggressively, taking the offer, because we're aware the party may just keep going in full force. For this scalp, we have a very specific intention. We really want to focus on the core idea here, which is let the party start. We let that momentum and the energy build in the scalp, and we look for that energy and momentum to carry us along. But at the same time, our objective in this scalp is to be there while the party's fun, then leave before it starts to wind down. We don't want to be the people hanging around at the end of the night, the ones that should have left hours ago, but they just didn't listen to the cues that the party was dying down. We don't want to be the ones they need to call security on to get us to leave. We want to have lots of fun while the party's going and make a graceful exit. We are letting the party get going. We're coming in fashionably late, and we're leaving while everyone's still having a good time. To do this, we're going to bring in the trading concept of a measured move. Measured moves are something that's commonly used in trading, and it's actually amazing how often they play out when they're measured appropriately. So at its core, a measured move is the idea that the next leg of a trading move will be roughly equal to the previous leg of a move. One super important key to measured moves is to understand how to measure it, to see why it's an appropriate target. In our case for this scalp, the distance from the low to the cross is the move. It's the distance we're measuring. Why? Because that's where we're identifying the momentum started building in our direction. This is following the turn. And where the real momentum started to show up for us, for our scalp. Whatever big players came in and created that turn, and then started establishing a new trend in the direction of our scalp, and then showed us the real momentum with the cross. Really, whatever factors got the party going, we expect them to continue for us. Even though the momentum started to build for us before we got the cross, once the cross happens, we have a distinct visual point of reference that shows us where the scalp started to turn in our direction. So we can measure that move from the low to the cross, and we can use that measured move as a guide of where to place our stops and where to take profits, what we call our reasons to sell. So the measured move idea helps us both with the stop placement and profit targets when effectively measured. Let's start with the stop placement though. We use a hard stop in this scalp of 1/3 of the measured move from the cross. So we quickly calculate the measured move, then we place a hard stop 1/3 of the measured move below the cross. If this scalp maintains its probability, if any scalp, really any trade at all, is going to maintain its probability of working, it rarely will retrace or pull back more than 50% of that initial measured move. This is kind of true on any time frame, and it's been observed since people started looking at charts. But just like any indicator, the context is so key to using it effectively. For this scalp, we're expecting that momentum to be so much on our side when we get our entry signal that we don't even need to give it all the way back to 50%. That just really shouldn't happen in this scalp. So we can risk less without lowering our probability of success, which is why we use 1/3 of that measured move as a stop. Again, 1/3 of that measured move from the cross to the low is where we place our hard stop. Just as we're using the measured move to place our stop, we're using the measured move for our target, for where we take our profit. Since this is a momentum move, and we took the time to understand how that momentum built for us in that scalp, we're looking for one measured move from the cross as our reason to sell, our profit target. Enjoy the party while it's rocking and move on before the music stops. This relatively close target gives us killer risk reward, however, because the stop is only 1/3 of that measured move. So we have a 3-to-1 risk reward ratio on a trade that works more often than not. That's killer edge. Over time, in all of our scalping strategies, we've been able to identify variables that increase the probability of success and those that decrease the probability of success. So beyond the exact rules of entry, stop, and target, we want to share with you the principles of probability so you can really put the odds in your favor even more and get great accuracy to really crush it with this strategy. Of course, if you just took every entry signal, there would still be a robust edge in this trade because of how it's built. But if you can increase your edge further, you should definitely not hesitate to do so as a trader. Where is the volume? If the volume during the convergence phase is greater than the volume during the divergence phase, this is information that supports our trade. Why? Well, if volume increases on the convergence, this means that we're seeing more market participation, more big players as that convergence occurs. It most often suggests that the convergence will continue because it has those bigger players behind it. Think of this like a party that has some celebrities showing up at it. It's much more likely to continue and become a huge night. This is best identified by simply looking at the volume bars on the chart. We don't need to be perfect here. It's not an exact science. You can clearly see if the volume bars are noticeably larger, more significant, when the short-term moving average, that 9 EMA, is diverging or when it's converging. If it's happening when it's converging, it can really increase the probability of this scalp working for us. The speed of the price action off the turn. Faster equals better most of the time. Speed is kind of a tricky thing because too fast can just be an overcorrection and not enough momentum's actually been built for us to be fashionably late and still get to enjoy the party. But too slow is actually not a good thing either. A good rule to use here is if the convergence occurs in less than 2/3 the time of the divergence. So if the divergence was 6 candles down, the convergence should be 4 candles or less up. This 2/3 tends to be the sweet spot for showing us the momentum's on our side without it being too fast, as is often the case with kind of those temporary snapbacks that are prone to fail. Price holding above the 9 EMA after crossing back above it. A very visual clue, but one that really increases the probabilities in our favor, is if price reclaims the 9 EMA almost immediately after the lows have been put in and retraces slightly during the convergence while supporting at or above the 9 EMA. This is what traders call riding the 9 EMA. When this happens, we can be more sure that the party's actually going well, since this indicator does show what direction the momentum is short term, and if the momentum is carrying it in the right direction, it should cleanly ride above that short-term moving average without any real back and forth. If the scalp is in the direction of a fresh catalyst. It's always better to scalp, it's just always better to trade with the direction of a catalyst. The more important the catalyst or the bigger the news, the better when this trade is going with that catalyst. We always need to know the bigger picture. If there is an identifiable market trend in the direction of our trade, we typically use SPY, QQQ, or IWM as a guide here. This will increase the probability of this scalp working for us if we're trading with the direction of the market trend, as kind of a rising tide lifts all boats. Choppy, slow, grindy price action off the turn. If it takes longer for the convergence to happen than it took for the divergence to occur, this decreases the odds that the trade is going to work. The party may be trying to start for us, but it just can't get going, and that's not usually our trade. Time spent around the point when the 9 EMA should cross back above VWAP. So if there's a significant pause after that initial move off the lows and before that cross occurs, it can show us that the party's trying to continue. It's got a little bit of momentum, but then others are trying to shut it down. So even if this scalp keeps going, it might not be as clean as we would like for this scalp. The standard rule of thumb here is if before the cross occurs, price pauses for more than 2/3 of the amount of time that it took price to move up off the lows, then you don't really want to get into this scalp. Again, so if the move up was 6 bars, we would not want to see a pause of more than 4 bars before that 9 EMA crosses VWAP. The momentum here just would not be strong enough to get the party started and then keep it going. And we may actually just have a different scalp entirely setting up. Ideal times of day. Knowing when the odds are highest for success for any given strategy is really helpful in having the highest odds of success of that scalp working. This scalp can occur at any time of day, but it's really ideal in the morning after an opening move is reversed or in the afternoon after a midday move is reversed. We want to stay away from those midday trades, those midday scalps, because we tend to get less follow through during that time period, as it's just generally a more choppy time of day. There are times when we will just not take this scalp at all. Here are some of those keys. We will not take this scalp when the price action is really choppy. So anytime that 9 EMA basically goes flat, if it goes horizontal for a period of time of more than 15 minutes after that convergence starts, but before that cross, so typically a horizontal or flat move shortly after that turn, we just don't really have this scalp. We will not take this scalp if it's fighting an intraday bigger picture market trend, Again, SPY, QQQ, IWM. That's how we define our bigger picture market trends. This is the inverse of the principle mentioned previously. We don't fight a clear, obvious, bigger picture trend. It can trick us because the setup can look ideal on a specific stock and it can seem like it's going to work. But it's very unlikely to work cleanly, and it's actually even less likely to get to target when the larger market headwinds are so strongly against it. So we avoid this scalp in this situation altogether. If you're executing this trade according to this rule set, and you're doing it in the conditions that are favorable for it, and you're avoiding it when the odds are lower, as we just discussed, you should see around a 60% probability of profit. This can actually become higher over time as you gain experience and can improve your edge further through tape reading, which allows for even better entries and exits. But even with the probability of this trade, you can get massive edge because the risk reward is actually stacked in your favor. Again, since you're playing for one measured move, but risking only 1/3 of the measured move, your reward is 3 times larger than your risk. Being right about 60% of the time while making 3 times more when you win than when you lose is killer edge that makes for a highly profitable strategy. Think about it this way using very simple numbers. If you risk $100 per trade, your losers will cost you $100 and your winners will make you $300. So over 10 trades, you would make $1,800 off of your 6 winning trades, and you lose $400 off of your 4 losing trades. That would net you $1,400 per 10 trades, even with the relatively tiny $100 risk per trade. We found you can trade this setup far more than 10 times in any given month, giving you thousands of dollars of profit potential. And if you risk several $100 a trade, that's 5-figure profit potential monthly off this one strategy alone. The real beauty of this scalp is the speed at which it can play out. Since we're waiting for the party to be started before entering, for the party to really get going before we show up fashionably late, these are often quick profits that can feel almost easy as trades, which can increase your confidence when you're trading it. So we really want you to understand this powerful scalping strategy very clearly. So let me walk you through some real-world examples, both long and short. And as you'll see, for this scalp and the others I'll be teaching you, we're using 1-minute charts, and most of the exits actually happen within 5 to 30 minutes max, with some rare exceptions. That's one of the things that makes scalping psychologically easier than other forms of trading. You're in and you're out pretty quickly, without having to sit in a trade for hours or even days, worrying about how it'll play out. Our second example on the long side, we're going to look at this. We see that same divergence occurring. You see the purple line, the VWAP, and the blue line, the 9 EMA. Then you see price try and make a new low. But then an interesting thing happens. We start to see this convergence occur as the 9 EMA and the price action catch back up towards VWAP. When it gets there, when it gets very close to there, that's when we start to pay attention and we look for that cross. As soon as the cross occurs, we take our measured move from the low to where that cross occurred, the price action where that cross occurred. We enter our position and we place our stop 1/3 of the way down. Then we're targeting one measured move to the upside. We see price continue its move higher, trending right, and then we take our exit at one measured move to the upside. So we're risking 1/3 and we're capturing a full measured move. This is an example that trips some people up, but it's an important one to cover. You see how quick that divergence is trying to occur. You see when price is looking like it's going to break lower. You see that divergence between VWAP, the purple line, and the blue line, that 9 EMA, occur. But then there's a quick convergence that happens as well. Once that convergence happens, we're paying close attention to where that cross might occur. And we see as soon as that cross occurs, we take our measured move, we enter our position long, we take our measured move from where our entry was down to that low of the move, we place our stop 1/3 of the way down the move, and we target one measured move to the upside. Price very quickly moves back up to our measured move target, we take our exit. That's very simple trading. We're going to cover quickly some examples on the short side. And again, this is really just flipping the charts. We see the divergence that's occurring between the 9 EMA, that's the blue line, and VWAP, which is the purple line. Then we see that convergence very quickly start to occur. So we're watching very closely as the 9 EMA prepares to cross VWAP. When that occurs, we enter our position short. with our stop a third of the range, and we're targeting one measured move back down. We get this almost instantly. It's 1, 2, 2.5 candles before we get that measured move to the downside. We take our profit and we move on. This example, we get a little bit of consolidation before the convergence starts, but the convergence is very distinct. That doesn't scare us away on this trade because once the convergence started, we see the smoothness of that convergence. So as soon as we get that cross where the 9 EMA, that blue line, crosses below VWAP, that purple line, we take our position. We very quickly measure the move and put our stop 1/3 of the move higher. Now we get a move in our direction, a quick move against us, which that's okay. We have our stop in place. We're looking for the momentum to carry us in the direction of the trade, which it does. The sellers step back in, drive us very distinctly lower. You can see how cleanly we're trending, how much that momentum's on our side, how much that trend is in our favor, and then we exit at one measured move below our entry. So that's the fashionably late scalp. Super powerful trading strategy with a robust edge. And here's the cheat sheet that gives you everything I just taught you in a super simple, easy to follow, summarized form. It's just 2 pages long. So this way you can quickly refer to it anytime you need it. And again, at the end of this workshop, you'll not only be getting this cheat sheet, but 4 more, one for each of the scalping strategies I'm about to teach you next. So make sure to stick around. Imagine the trading floor during the open on any given day. The opening bell rings. There's this quiet intensity that hangs in the air as traders focus in on their screens, absorbing the information presented by the stocks in play on the day. This palpable focus is broken by an occasional call out as a stock surges upward. This initial drive, while common, often results in a subsequent pullback as the dance of power kind of ensues between buyers and sellers. Price moves higher, which can attract more sellers who are ready to get more for their stock than they could just minutes before. But every so often, something kind of intriguing happens. Instead of just fading away, the stock's price kind of holds its ground. This is no ordinary play. This is the arena where a big player is making a move. When you spot such activity on an in-play stock, know that there's this colossal player in the mix, one that could potentially drive the price even higher. But why? So real institutional buying programs, they're not fleeting moments, they're marathons. These marathon runners don't sprint and stop. They know how to set an aggressive baseline pace, and they'll pick up that pace from the baseline as needed to do their job, to get their orders filled. Our task? Well, it's to hitch a ride on this unstoppable force and let it pave the way for us. So when a stock refrains from pulling back, it starts that narrative shift. On the desk, you'll hear some traders who shorted the stock on that initial thrust up with an expectation that they would quickly be rewarded with a deep pull-in. You'll hear them start to get frustrated. This stock should not be holding up like this. It should not be consolidating like this. The consolidation might vary, but our experience gives us indications that a consolidation period ranging from 5 to 20 minutes, with the low of this consolidation planted firmly in that top third of the day's trading range, is exactly what we're looking for. To the untrained eye, these may seem like random orders, but for us, they're telltale signs of a large institution putting in orders, big players at work. These orders aren't haggling for a bargain. They have a singular mission. That mission is to get filled. The market's going to yield to their desire. It's going to propel the stock higher. And our strategy is simple. We're just going to ride along. Now let's delve into the specifics. Entry rules. So the moment we enter is when a 1-minute bar breaks higher. It breaks out of that consolidation, which we fondly label the hitchhiker candle. Part of why we call this the hitchhiker scalp is a story for another day, but that candle that distinctly breaks the consolidation to the upside is our hitchhiker candle. We want to hitch a ride using its burst of momentum. We don't want to be passive. We need to hop in aggressively. So as soon as that range shatters, we want to pay the offer for a long. We don't want to linger, wait for the bar to close. The range break is our chance to get in and catch a ride with this big player. Stop placement. Anchor your stop 2 cents below the trough of the preceding consolidation. This isn't a game of second chances. It's a decisive move, a one-and-done scalp. Picture this stock's movement as waves, ebbing and flowing, yet kind of relentless. After the first surge of momentum following our hitchhiker candle, that first wave out of the consolidation is given a rush of buying. We're going to exit half of our position. This rhythmic motion of the stock, especially under the influence of a buy program of a big player, it offers us the perfect exit strategy. It gives us a balance of riding the real momentum that occurs when there's a relentless drive for this big player to get filled with the passive but steady baseline pace that's set as the stock rests. After this rest, as the second wave initiates, often kind of grinding its way at the start with a burst towards the end, we let that rush give us our exit of the remaining half of our position. In the wide open spaces of trading, amidst countless strategies and maneuvers, the hitchhiker scalp gives us a way to catch a ride with a big player and allow the flow of their large orders to drive us to a great scalp. In terms of stats, this scalp has an accuracy of around 55 to 60%, with a reward to risk ratio of around 1.9, which is a really solid edge. You win just over half the time, but your winners are nearly twice as large as your losers. Now that's a formula for trading success. And I just want to mention something here. So you probably see many supposedly high accuracy trading systems being touted out there by trading educators and systems vendors. You'll see things like 80% or even 90% accuracy. Now, this of course draws in traders because everyone loves to be right and have high accuracy. But what the people selling you these systems often kind of fail to mention is that such accuracy usually comes with inverse risk reward. Meaning, yes, you can be right 80 or even 90% of the time, but your losers are usually 2 or 3 times larger than your winners, and sometimes even 5 or 10 times larger. Meaning you're going to win 8 or 9 times out of 10, and then 1 or 2 of those losers are going to wipe out all your profits and then some. Such systems are rarely ever really profitable. They're just feel-good systems that are easy to sell. But do you want to just temporarily feel good, or do you want to make a consistent money? If you want to make the latter, you need to trade like the pros. Virtually all of our professional and elite traders are typically trading 50 to 60% accuracy strategies. But these strategies have larger winners than losers, typically 1.5 to 3 times larger. And that means that they have a very solid large edge. That's what you should care about. You need to trade for overall edge, not for accuracy if you want consistent profitability. You need to let go of your need to be right on any given trade and focus on strategies that make money overall. This is the only thing that will bring you to the consistent profitability you're after. Now, having said that, let's see some examples of both longs and shorts. Our second entry was a very important one to cover. Our second example, very important one to cover because it can trip people up. So you need to be aware of this and be prepared for it. What we see here is you get a first move up and this little chop, but then a first move up with a choppy consolidation. Well, when you see the volume that's supporting it and that choppiness in the consolidation, it's actually trying to correct. But buyers are saying, I need stock, I need to get in. So we enter on that break of the consolidation. Our stop goes below the low of that range. So even this little attempt to drop out, well, what happens? The buyers step right back in where that consolidation occurs, and we ride that first wave higher. We exit half our position to the first wave. This one is a long hold. This is not a normal example for this trade, but it's important because you can see how that wave takes time to develop. But once the power of that wave starts in our favor, look how cleanly it trends and then finally capitulates with that big whoosh to the upside where we exit half of our position, the second half of our position. In our third long example, we're covering this specifically because of something that can trip up traders. This is something that can kind of make people a little uncomfortable, but there's a trading concept around it that makes it such a valuable thing to cover. So we have our consolidation. We get the first buying pressure, that unusual buying pressure. And then we see this consolidation occur. And then we see the break, which gives us our entry. We can place our stop below the low. And again, similar to something we saw before, it feels like, oh no, this could fail. Well, if it doesn't fail, what is that telling us? It's actually telling us the buyers are there and they're really going to continue to support the stock. They have stock they need to buy and continue to get filled. So we can ride the moves, ride that first wave up. We exit half our position into the first wave. We see that little pull in, that consolidation, and then that quick and abrupt second wave higher. That's where we can exit the second half of our position and move on with this scalp. We're going to cover our first short example. This is one where we get that first move lower. We get that consolidation. You can see how we attempt to break higher first. When we attempt to break higher, it's similar to what we talked about in the longs. You get to actually see what's happening with the sellers. Are they really interested in selling this stock? When we see that, that is a really good piece of information. They're actually stepping in and selling the stock the way we want them to. So when you see that, that's actually a really nice factor in recognizing a good trading opportunity for the hitchhiker scalp. So we can enter on the break below the range, and then we're going to use the waves to exit. We're going to get that first wave lower. We take half of our position off. And then we expect that kind of wash as we go back and forth a little bit. And then we get that second distinct wave lower where we exit our position and we move on. Again, from the open, we get this first move down. It's an unusual sort of move because it doesn't correct. It attempts to correct in this little consolidation, but it's not able to correct. By correct, I mean move back up in price. This is unusual selling pressure. It's very unusual for us to observe a stock that is doing this. So what can we do? We can try and hitch a ride on the move. When the range breaks to the downside, we enter our position short. Our stop goes above the range, which is right where those sellers really stepped in. When the buyers tried to step up, the sellers said, nope, we've got more stock to sell. We're going to continue to sell this. So we allow this to occur. We have our stop in place. And then we ride that first wave lower. We exit half of our position into the first wave. We kind of anticipate and are comfortable with that little pop against us because we're looking for the selling pressure to sustain. It does, and we ride that second wave lower. We exit the second half of our position into that second wave lower. Now let's dive deep into the backside scalp. A strategy that some of you may have heard of, but it tends to be a scalp that trips traders up. It's unfortunately misrepresented in a lot of ways, making it a scalp that only a few truly grasp. This is a strategy that relies on our understanding of human emotions, market movements, and precision. And together we're going to walk through and we're going to demystify it. Imagine an in-play stock. It's kind of drifting lower away from the familiar territory of VWAP, seemingly unstoppable in its descent. Many might perceive this as this never-ending downward journey. Traders who've shorted the stock, they're on cloud nine. They're visualizing the profit, anticipating an even steeper decline. They're getting that dopamine surge that comes from feeling like you just won. That surge that makes the slot machine business so incredibly profitable for casinos. But here's where the magic happens in the backside scalp. The stock stops going down. It doesn't continue its decline. Suddenly, buyers come to the forefront. Like a supportive community, the buyers rally around the in-play stock. They rejuvenate the stock. They're stepping in with this passive but consistent demand. Their combined force not only halts the downtrend, but even pushes the stock upwards, heading once more towards the VWAP. This transformation isn't random. It's actually very clear on the tape. And on the chart, the backside sets up as one clear higher high. This signals a shift. One unmistakable higher low. This is a testament to the resurgence going on. And then one clear and unmistakable consolidation. What's occurred is a change in the narrative. Those shorts, the previously excited shorts, their judgment slightly clouded from that dopamine rush that they were feeling. They're now finding their emotions oscillating between hope and rising fear. Deep down, they know their short trade's no longer working. The stock has made a higher low and a higher high. The stock is showing a resilience they didn't expect. There are now multiple checks against their trade. That earlier confidence they had erodes. It's replaced by that looming fear of having to take a loss on a position that showed so much promise. And this, my friends, is where the backside emerges. So how do we capitalize on this? As soon as the backside makes its presence, we get ready to act. We've seen the shift in the character of the stock. We've seen how it said, that's enough. Sellers are done winning. The stock stood up and started its climb back towards VWAP. Shorts kind of battle with it on its climb, but it stays steady and it gets to a point of balance. The stock is no longer trending up or down. It kind of begins to consolidate. When we see the highs of that consolidation breaking, we jump in together. Remember, during this backside phase, the stock is steadily rising. So when the consolidation breaks, we'll act promptly and we'll enter our position long. Precision is key. We get one shot at this. We're placing our hard stop just 2 cents below that last higher low. It's a commitment. It's a pact we make to this scalp and to each other. Placing an appropriate stop is a non-negotiable. If you're risking $100 in a scalp, it's actually irresponsible to lose $150 in that scalp because you wanted to give it just a bit more time to see what happens. We return to our starting point, to VWAP. As price breaks the consolidation and extends rapidly into VWAP, we're going to exit. We're going to capture that fast move. To sum it up, the backside scalp is more than just a trading strategy. It's this symphony of observation, understanding, and timely action. It's a way to be rewarded for our patience, to allow others to succumb to fear and greed, and to expose themselves to emotional decisions. It's a way to systematically enter a scalp with trading edge. In terms of stats, this scalp strategy has an accuracy of around 50 to 60% and a reward to risk ratio around 1.4 to 1, giving us a clear and consistent edge. Now let's take a look at some examples. In our second long example, we can see the price action driving lower, and it looks really good for a little bit. But then we start to correct, and we put in a distinct higher high and a distinct higher low. These are very visual. These are very distinct. And then we get this little consolidation that's occurring. After that price action, if you're short, you've got to be very uncomfortable. Longs are looking for a really good opportunity here. When we get the break of the range to the upside, particularly one visual clue is when we get a lack of volume just before that break of the range. That can be a really good opportunity. It's a little trading secret that we look for. But we get that break of range to the upside on an increase in volume. Then we put our stop immediately below that higher low, and we're targeting VWAP, this purple line. When we get that sort of momentum to catch, we exit right into VWAP for a very quick and effective scalp. For our third long example, we're looking and it looks like the price action is going to drive significantly lower on the day. It looks like something distinct has changed, but then the buyers step in. We put in a distinct higher high and a distinct higher low, and then we have this consolidation to work with. When we see the buying pressure break the highs of that consolidation, we enter long with placing our stop just below the lows of that higher low. We're targeting VWAP, which is this purple line, and we see how even after that first dip out, the buyers step right back in and drive us right to VWAP, which is our target. We exit our position, move on with our day. A lot of people will ask what's the most appropriate way to enter this position. And we've laid out very clear rules. We're going to cement them here. We're going to show an example that can trick people up. What we get is a move up, and it looks okay, but then what happens? We get a little deeper than expected pull-in. That puts in a lower low. And then we come in and we put in a lower high. Well, that technically is the entire range that we're working with here. So although we get this consolidation, and people will try and cheat this break and trade this breakdown, they'll try and cheat the trade basically, or the scalp, and they'll try and hit it on this breakdown. The probabilities aren't entirely on our side in the same way. So we wait for the range to break. When the range breaks, we enter our position short and we put our stop above that lower high. Even when we get tested a little bit, that gives us an opportunity to see how the sellers are doing. Are they really in supporting the position? And yes, they're in there selling the stock when we get that little pop up, but it can't even hold any higher. Well, that's really what we're looking for in this stock. And we can ride that momentum down into the VWAP, that purple line, where we exit our position and move on. This is one of my favorite examples because it really exemplifies the trade entirely. So we see how there was a slow, grindy action up and then a distinct move that came in, and we put in a lower low, and then we put in a lower high, and then we get this range that develops. On the break of the range, we enter our position short. We put our stop above that distinct lower, high. And this is exactly what can happen sometimes. The buyers that were participating in this move before on the front side are now completely wrong. They're in a bad position. And what they're going to do is just puke their stock. They just have to exit because their trade is no longer working. So what you get is this whoosh down into VWAP where we exit our position, we move on with our day. Now I'm excited to share with you a killer strategy, one that weaves logic and joyful trading together, the second chance scalp. Fasten your seatbelts and let's dive into this fascinating realm. So picture this, you're observing a stock that's in play. It's setting up a consolidation. It's trading between a defined area of support where there's a demand to buy the stock and an area of resistance where there's supply of the stock to sell. The key to consolidations is that there's a pending resolution. It's setting up to break. And once it breaks, many traders will try to focus on catching that break. But this can cause a challenge. For some reason, when an in-play stock has been gyrating up and down in a bit of a choppy manner and then breaks the range, that initial break is really tantalizing, isn't it? But it's kind of akin to playing a high-stakes game of hot potato. Unlike the tight, defined range of the hitchhiker trade that sets up an easy breakout, this is a game where your prowess in reading the tape, perfecting your timing, and making a swift exit when the momentum wanes determines your success. However, what if I told you that there's a trading strategy with less fickleness? A strategy more forgiving, more reliable, and one that, frankly, can give more consistent opportunity. Enter the second chance scalp. This isn't merely a scalp for our traders, but it's really a revelation. After that initial dash out of range, as price retraces back to the breakout point, the second chance scalp lets us peek behind the curtain. We get a privileged view. Are there genuine higher time frame buyers? Are there big players? Is that resistance level that held so well previously, is it morphing into support? Or was that breakout all a fleeting bout of buying? This scalp reaffirms the time-tested trading principle that prior resistance can become new support. And when it does, we let an awesome scalp just hit us right between the eyes. Now, you might ask, how do we attack this second chance scalp? Let's break it down. The entry. We wait for a break. We watch price puncture resistance with a determined, unmistakable move. We let that candle close confidently above that resistance level. Then we look for a retest. After the breakthrough, we watch with a sniper's eye as the price revisits that broken level. This is our moment of reckoning, observing if the old resistance graciously steps into the role of new support. If the big buyers, those big players that broke that resistance level, are going to step higher and buy more. We seize the moment. Once the second chance is corroborated by the resurgence of buyers and a candle closing above its predecessor, one candle closing above the other, we strike and we enter our position. Stop placement. The simple and straightforward stop placement. We're going to position it 2 cents below the low of the turning candle. This low often aligns with our reformed hero, the old resistance turned new support. The exit. For this scalp, we break our exit strategy, our reasons to sell, into 2 different exits. This is not to confuse you. It's to arm you to take advantage of a quick burst of momentum while also capturing the sustained buying pressure that comes from the big players creating this scalp for us. We call this exit strategy, our reason to sell, we call it half and trail. Half and trail is really pretty simple. We sell 50% of our position when we reach the prior high, and then we play the waiting game with our eyes on a 1-minute bar close below the 9 EMA on a 1-minute chart. We start by using the visual cue of where the pullback started, where that unease started for those initial longs, and we place our exit target for half of our position 2 cents above that high, and then we look for sustained buying pressure to lift our offer. After that occurs, then we trail the other half of our position higher. We allow those big players to take us up and up. We're waiting to exit the second half of our position until we get a red bar that closes below the 9 EMA. This can signal a potential short-term pause in the momentum. In essence, the second chance scalp isn't just a scalp, it's an epiphany. It combines the cold, calculating logic of being a sniper with the joy of letting the trade truly fall into your lap. It's a scalp that sidesteps emotions and grounds itself in the trading edge that comes from prior resistance becoming new support. In terms of stats, this scalp has an accuracy of around 50 to 55%, with a reward to risk ratio of around 1.9, which again is a really strong edge. So you win just over half the time, but your winners are nearly twice as large as your losers, making it relatively easy to hit consistent profitability. Now let's take a look at some examples of this scalp. In our second example, we see this very deep pull, but it's an important thing to cover because when you get that pull, especially if you're long the stock, you're going to get a little nervous. But for us, when we're looking for that second chance scalp, we can use it as an opportunity. We use it as information. Where does that sell stop? Where do they stop selling the stock? Well, immediately where that resistance was before, that becomes support. We see that quick wick below, but then the buyer stepped right back in. That's the essence of the second chance scalp. We see the real buyers that are in the stock now. So as soon as the candle gets above the prior candle, we can enter long. We place our stop right below that low, which again happens to be just below that area where that was resistance and is now support. We ride half of our position up into the prior turn, where that turn started. We exit half of our position there, and we trail the remaining piece using the 9 EMA, which is this blue line. And when we get a close below the 9 EMA, we exit the second half of our trade, half of our scalp, and we move on. Our third long example gives us a really clear view of how important it is to allow that resistance to become support. We see this move above, but it doesn't really ever, pull in. It just kind of one candle down, and then we try and break out. But what happens? We get this really distinct pull in. This is what a second chance scalp looks like. We get that move lower, and you can see that resistance now becomes support. The buyers step right in. We enter our position when it clears the prior candle. Our stop goes simply right below those lows where that buyer stepped right back in. And that happens to line up right where that breakout initially occurred, right where that resistance level was initially. That's now support. We can exit half of our position where that turn started, where that initial turn started, and then we trail the second half of our position until we get a close below the 9 EMA. That's that blue line right there. Take our trade, move on. Now we're getting into the scalps on the short side. So we can see that there was buying pressure right here through the day. Buying pressure, moved up. Buying pressure, moved up. When we break that and then retrace, all of a sudden that area that was support clearly became resistance. The seller stepped right in there. So we wait for a bar to move below a prior bar. That's not something we get on the first bar, but we get it on the second bar. We place our stop just above where that retracement happened, where the buyers from over here became sellers from over here, where that support from over here became resistance from over here. That's where our stop goes. And then we ride our position down. We cover half into those right above that turn, where that turn started. And then look how nicely we're rewarded, allowing the 9 EMA to trail with us. And we wait until we get a close above the 9 EMA to cover the second half of our position. In our final example, this is actually one that we've seen before, and it's a great way to identify what can happen when you're scalping. You can take multiple scalps within the same move that each have their own edge. It's called stacking the edges. So instead of saying, how do I add to this position? The question we really ask ourselves is, what trade am I making specifically? In this case, we had a hitchhiker scalp that was developing, but then a second chance scalp also developed. What do? Well, you take each trade on its own merits. So the hitchhiker scalp has its own stop and its own targets. And if you want to do this, you can take the second chance scalp on its own stop and its own targets. So that's how you add to winning positions, is you actually take more trades that set up with their own sources of edge, with their own sources of opportunity. What we have is that break below, and then you can see the retrace. Well, we don't short on that retrace, that failure on that support area that became resistance. We wait for the bar to close below, to get below, and we short there with our stop above where that area was support and is now resistance. We exit half of our position into the new lows, which happens very, very quickly. But again, then we're trailing, waiting for a close above the 9 EMA. The first time we get the close above the 9 EMA doesn't happen for a pretty significant period of time. So we're holding that second half of our position, really looking for that. Picture a rubber band being stretched to its limits, the tension building, every fiber stretched to its utmost capacity, just waiting for that moment to snap back into its original shape. This is the heart and soul of the rubber band scalp. We've all witnessed the stock making an extended directional move, methodically grinding down as if every tick lower was calculated and controlled. This is the phase when sellers are in no rush. They gently press the stock lower and lower. But then there's a shift. The pace quickens. The big player no longer wants to wait. They're eager, impatient. They're perhaps even desperate to offload their positions. In their hurry, they kind of become sloppy, careless about their execution price, driven by more urgency than strategy. This frenzy creates an extreme, almost palpable pressure. And this is where our opportunity emerges. This isn't about a mere price extension, no. It's really about the recklessness in the acceleration of the selling. When this hasty selling climaxes and ends, the stock, just like our metaphorical rubber band, is bound to snap back, reclaiming its equilibrium. Now, what does reckless mean? What does sloppy mean? These are good thoughts, but how do we define them? We define these terms in the rubber band scalp by using price action as it relates to Bollinger Bands. Specifically, we're looking for a close below a lower Bollinger Band before we even can have this scalp setting up for us. Why Bollinger Bands? Well, Bollinger Bands measure standard deviations from a moving average. So what they really measure is extension, the sloppy extension. They're a measure of how far that rubber band is likely to be able to stretch before it's just too much. Our role? It's to seize the moment, to ride this powerful wave upward. And how do we identify this very moment of opportunity? We watch for that one resilient green candle, breaking free, clearing the highs of not one, but two or more preceding candles. As soon as we have a candle that clears the high of the prior two candles, we're looking at a 1 minute chart here. So when one 1 minute candle clears the prior two 1 minute candles, creating a double bar break, that's our cue. And we don't wait. As soon as we have our entry criteria, we step into action. We're buying aggressively on the offer without even waiting for the candle to close. In terms of protecting our capital, this strategy is clear and it's very uncompromising. We place a hard stop, a mere 2 cents below the low of the day. We operate with a conviction that the sell program has culminated and our snapback candle has set the floor. We're in for a scalp. If this trade doesn't work the first time for us, we can reset and we can take it one additional time if it sets up for us again in the same stock. But this is a 2 strikes and we're out trade. 2 attempts and that's it. But while our entry is aggressive, our exit is actually very methodical. We're going to partition our exits into thirds, ensuring that we capture profits while also giving our trade the room to breathe and expand. We seek a risk-reward ratio initially at 1-to-1, and then pushing further 2-to-1. Finally, we allow the stock to take us out of that last third of our position into VWAP. The beauty of this approach? It's symmetrical. What works in a bullish scenario is just as effective, but in reverse for bearish setups. Overall, in the vast ocean of trading, amidst the chaotic waves of price actions and market movements, the rubber band strategy stands as a lighthouse, guiding us to seize those rare yet powerful opportunities. It embodies both the calm and the storm, the patience to wait and the aggression to act. Embrace it, perfect it, and enjoy letting this trade work for you. In terms of stats, this strategy has an accuracy of around 60 to 65% and a reward to risk ratio of 1.6 to 1. When you're winning nearly 2/3 of the time and your winners are 60% larger than your losers, you have a killer edge. Execute it consistently, and it's hard to lose money over time. Now let's check out some examples to bring it more to life. We won't show the Bollinger Bands on these charts because they really just kind of cloud the example. We kept the charts clean. Just like we do on all our charts, we're showing the price action, the 9 EMA, and VWAP, which is our final target for this scalp. We can see how quickly this acceleration can turn sloppy in this example. So you see the trend kind of is coming down in the stock, and then you can see how urgent the sellers get. They just have to get their shares off. They have to do this. They don't have an option. They have to exit their position. We don't care really why. We're just observing. As long as there's no negative news or fresh negative news in the stock, we're observing them needing to exit, needing to exit, and needing to exit. And then we're waiting for our trigger to set up. When we get to that extreme, and then we get this little consolidation area that occurs, and then we get a double bar break to the upside, that's our cue. That's that indication that that rubber band got stretched too much, and we could be looking for a really nice scalp back to the upside. So we enter our position, our stop goes 2 cents below the low of that move. So in this case, 2 cents below the low of the day. We exit 1/3 into our first measured move from our stop or from the low to our entry. We exit another third into 2-to-1 risk reward or a second measured move. And then we hold our position. I know that it pulls back against us, but we're, again, holding just our final third, and we're allowing the stock to build as it makes its way back towards VWAP where we exit, this purple line. In our final long example, we're going to cover something that happens in the rubber band scalp that actually improves the odds of this scalp working for us. We get our acceleration away from trend. We get our distinct double bar break that's occurring right here after a really extreme move. And then what happens? The stock kind of comes in a little bit. Well, we get to see, are the buyers really real? Are there big players now buying this stock when other sloppy big players were selling the stock when they just needed to get out? When we get that little pause and the buyers step right in, that's telling us that there's sustained big players that need to buy this stock. That is exactly what we want to see for this trade. So we exit 1/3 of our position into a 1-to-1 risk reward. We exit another third of our position into a 2-to-1 risk reward. And we hold the final third of our position, trailing it with us all the way up to VWAP. We just allow the stock to pay us on that final third all the way to VWAP. This is a quick and distinct short example. We have the acceleration from trend. We have that drive away. And then we get that really distinct double bar consolidation, double bar break. We enter short, our stop goes above the high, 2 cents above the high. We exit 1-to-1 for 1/3 of our position. We exit 2-to-1 for the second third of our position. And the final third of our position, we exit right into VWAP, this purple line. In our last example on the short side, we see this acceleration away from this trend, acceleration, we're getting sloppy. And we don't predict it, but when we get this double bar break to the downside, we almost get a triple bar break. But here we have a double bar break to the downside. That's our distinct moment of entry. We enter our position short, our stop goes 2 cents above the high, we exit 1/3 of our position into 1-to-1, 1/3 of our position into 2-to-1, and we trail the final piece and we allow it to work for us as we go all the way back to VWAP, the purple line, to exit our final third of our position. And there you have it, 5 of the most powerful scalping strategies that we've been trading on our desk for many years. Cumulatively, they've earned our firm tens of millions of dollars. And now you have the exact rules of every single one. And once again, at the end of this workshop, we'll be giving you each of the cheat sheets for these strategies. And as you saw with the fashionably late scalp, the cheat sheets give you all of the extra details for even better and more precise execution. I hope you'll make a killing from these proven scalping strategies.
Not every of a Wall Street prop firm. And definitely, again, make sure to stick around because at the end of this workshop, you'll be getting all 5 cheat sheets, one for each of the scalping strategies you just learned. In the first strategy, the fashionably late scalp, Jeff taught you every single execution detail, including the factors that increase the odds of it working, the ones that decrease the odds of success, the ideal times of day to take the setup, when to avoid it altogether, and some other helpful guidelines. In the cheat sheets, you'll find all of these details for all 5 of the scalps, so you'll definitely be more than rewarded for your time. But now for the most important question of all. What is the price of access to such a revolutionary trading tool that does most of the heavy lifting for you by handing you all 5 of these robust, profitable scalps on a silver platter day in and day out? Well, first of all, we can almost guarantee you that no other Wall Street prop firm would ever share such a tool with the independent trader community. But, like our co-founder Mike Bellafiore mentioned earlier in the video I showed you, SMB Capital is built differently. Our culture, from day one, has always been about finding and developing trading talent from scratch from all walks of life. Talent is talent, and talent is everywhere. And to do that, we've always shared generously with the global trading community. Our thesis, which has proven correct over the years, is that there will be many passionate and dedicated retail traders or complete newbies who learn our strategies, see their main trading talent that we'd otherwise never have found. And of course, since our main business by many magnitudes is trading the markets, the more traders we attract and develop into elite talent, the better we do. This has been our philosophy from day one, and we believe it's one of the key reasons why we've been one of the most successful and longest lasting proprietary trading firms in the world. And so that's why we're even willing to offer this proprietary tool to independent traders. Now, in terms of cost, realize that this took us over a year of in-house development work to build, and the result is nothing short of revolutionary for scalp trade execution and simultaneous skill development. That combo is priceless, believe me. And in our view, it's easily worth tens of thousands of dollars. Most traders would easily save that much when you factor in not only all the time they'd save in becoming consistently profitable traders, but also all the poor trades they'd avoid during that time. All the trades that produce countless losses because they're either not based on real-world edge, which we'd say about the majority of the strategies being taught out there by trading educators, or the trades that have edge but are executed very poorly due to chasing the market, missing the ideal entry, not using the right stop, executing in wrong conditions or stocks that aren't in play, and on and on and on and on. All right? And so for most traders, the added cost of all the poor trading they typically do in the first few years of trading, if they can last that long without totally blowing their account and being forced to quit, is typically in the tens of thousands of dollars. And we've heard many stories when it was well into the 6 figures. But when you have a revolutionary trading support tool that alerts you to potential setups that all have built-in edge based on the trading experience of the elite traders of one of the world's top proprietary trading firms, and you learn to execute that edge based on easy-to-follow rules and guidelines, you're not only building true trading skill, but you're likely saving years and tens of thousands of dollars of needless losses, while also having the potential to earn profits from your trades as you build your skills. And so a price tag of tens of thousands of dollars would actually be quite fair. But of course, remember our main goal and the culture of our prop firm from day one. We believe in sharing our knowledge and expertise with the global trading community as a way to attract top trading talent over time from all walks of life. That's how we grow our P&L prop firm, which is by far our biggest and main business. And so to do that, we obviously would not be doing ourselves a favor by pricing a revolutionary product such as this in the tens of thousands of dollars, even though that's what we feel its fair value is. And that's why we're not charging $30,000 or $20,000 or even $10,000 for it. Instead, we've priced lifetime access to the SMB Scalp Radar, which on average will likely produce anywhere between 7 and 12 robust scalps with a strong real-world edge per day for only $6,000. However, even though this price is a steal, given how much money the Scalper Radar can save you and potentially make you each year, let alone year after year for a lifetime, and let alone its potential to help you reach consistent profitability much faster than you ever thought possible. For those of you still here on this workshop, showing that you're clearly very serious about your trading and that you could one day be the very trading talent we'd love to hire, which could happen if you reach out to us even after only a few months track record of consistency with these scalping setups. We're going to take the $6,000 price and we're going to discount it down to only $1,997. That is literally 67% off our regular website price and a savings of over $4,000. And this is a special limited time offer available only for this workshop. And again, this is lifetime access to a revolutionary trading tool that hands you numerous high-quality scalping opportunities per day, day in and day out. And there are no subscription fees, no renewal fees, and no hidden costs. It's simply a one-time payment of only $1,997, and you get full, unlimited, lifetime access to it. And the beauty of this is that not only is it a one-time investment for something that has the potential to produce incredible returns year after year after year, but because you have lifetime access, even if now's not the best time in your life for you to jump into learning and trading it right away, you can join now to take advantage of this massive discount and then simply begin whenever's the best time for you. With lifetime access, you would have lost nothing by getting in now